Hi guys, welcome to another episode of Finance Talk, where we speak about finance, business, and investing. I'm Eugene. I have more than 10 years of experience in business. I also interested in finance and building my own portfolio and hoping to set up a fund in the nearest future.
And I'm Nick Rational. I too have a lot of business experience and been doing the investing for a while now. Together, we're going to share with you what we have learned, and together we can all learn more and become greater investors. I too hope to start a fund in the near future, and let's all learn together.
So, what will be our today's topic, Nick?
So, what I thought we would discuss is something that I've not seen discussed in good detail on other podcasts or YouTube videos, not in any of the courses I've done or any of the books I've read. It seems to be the least talked about topic, but it's probably one of the more important ones. I always felt that for beginners and even intermediates, this is the part that stresses people out the most. They never know if they're doing it right. And we should talk about all the options of how to do this part of investing. And this part is when to sell your stocks. And so I've got a whole little list of things to discuss.
I think that we can start with explaining that even the greatest Warren Buffett, who is considered the buy and hold investor, is not purely like this. He buys the company at a particular price, understanding the intrinsic value of it, and he just sits and watches the company, understanding whether it's overpriced or not. And he's a really, really long-term investor, but when he sees the negative aspect which can hit the business or some unreasonable economic events like it was with the COVID, he just sold his position. So he really understands where to sell.
So I would say one of the first things on the list of reasons to sell, and one that we can talk about for a little while, is the planned sale. That's when you always knew when you would want to sell, and it's nothing unusual, nothing's changed. You bought at a certain price, and you had a plan to sell, and this is going to be different for everyone. There's probably a lot of different choices you can make on when to sell. For example, just one idea would be if you bought in at a 50% margin of safety, that's half of the fair value that you've calculated. And you predicted, because it was like an event that occurred and you knew that event would sort itself out, you predicted that it would go back to the fair value, say, in a year's time, and you double your money. Now, when it gets to that point where you've doubled your money, do you sell everything and be happy you've doubled your money, look for a new opportunity? Or do you take out just the original amount you put in and let the rest sit there as sort of free money, like the casino's money, as it were, and let that see if the company will rise further, and then use your original money to find a new deal? So there's a couple of choices you have, and some people do it completely differently. They might just see how much further it goes, and every extra 5% above intrinsic or 10% above intrinsic, maybe they'll take out 10% of their money. So there's a lot of different options. What are your thoughts on that, Eugene?
I agree with you that there are different approaches to investing, and most popular value investors consider their purchases of shares as a long-term gain. So they can just sit and wait for 5-10 years in order to receive 10, 20, even more access for their money. But if you are not something like that, and you're more short-term investor, and you play completely on the special situations, which are absolutely right and okay. Even Buffett started with such kind of things when he was with his first partnerships in 1960s. So you just need to consider the outcome. I personally consider myself as more long-term investor, but I try to look for companies which can produce 26% annual growth, both in revenues and in profits. So if I just purchase the share and I do not see these dynamics, I have two options. I can wait, and I think maybe the market doesn't appreciate and doesn't understand the value of this company, even though this is a great purchase. Or I think that okay, I learned something new. I continue educating myself, and I try to reevaluate the company to really understand whether it's worth this number or not. And if I do not have any positive outcomes for myself, I just sell the shares.
That's interesting. Your thesis is to look for companies that grow at a 26% rate per year, while mine is more like I'm looking for an event that will misprice the stock by 50% and recover within 3 years, and which equals a 26% per year return. So we're both going for the same percent return, but using slightly different methods. I like that a lot.
Yeah, and actually, I also use this technique to evaluate the entrance to the company, like the event part. For example, recently I analyzed the company which has really poor management, or the management which is under legislation and all this investigation by the SEC. But the company is really great and it operates outside of the competence of the CEO. And these are completely different businesses. They just work by themselves. And for me as an investor, this negative event is the positive one. So I can buy the shares at the lower price with the PE of 2, and I can double my money in the nearest future. I think we do not know what it will be, but there is a high probability for that as well. Speaking about this particular company, there are combinations of both long-term and short-term gains, because even if the company has PE of 2 and price to book like 0.8, this is a long-term play, and this can be a really great compounder for the long term.
Excellent. I look forward to seeing what how this company does. Although I know that it's probably not a large portion of your portfolio, each choice you make definitely affects your return. And knowing when to sell, that's pretty important. So I think maybe a good last thought on this particular point of selling, because we've got multiple points, the planned sale, the last point to think about to determine what kind of planned sale you might have is to think about the kind of investor you are. Do you invest in companies in different phases of company life cycle? So, for example, if you're buying a company that's very small and you're projecting massive growth, you're looking for a 10x company, I would call that a rule breaker company. It's a first mover, top dog kind of thing, like what they talk about in the Motley Fool. That kind of investor will have a different planned exit points to someone who might be after a more mature company, that's a larger company, that's growing at a very definitive rate. They're not looking for explosive growth, but you're looking at it doubling in the next 3 years, that kind of thing. That in the Motley Fool, they talk about that as a rule maker. There's different names for these kind of companies depending on which investor you follow, which investment gurus or which books you read. But effectively, where you are in the business cycle is going to determine what kind of investor you are, and also when you want to exit. A venture capitalist will exit when the company moves up to the next stage in the process. And we should look at all the different phases ourselves to determine the best time to leave a company if it's a planned sale. Personally, I like the idea of pulling out most of the money or most of the profits or even the original money when it hits intrinsic value, and then keeping a little bit in case it continues to rise ridiculously. Some people use more advanced tactics to try and get every bit of profit out. Maybe they'll use options, and so they'll tranche out as the profits get more. Tranching is where you do maybe a quarter of your money at one price, and then like another quarter at a higher price, and so on. And then by using options, you're getting paid to do what you would normally do. But if you're a beginner or you're not managing much money, options are probably not for you. And we will talk about options on a different episode. But that's the end of the planned reason for selling. So on to the next reason to sell. So that. It's funny that we've got a lot of reasons to sell, but the only one is the planned sale, and all the others fall under the category of unplanned sales. Okay, so the first reason that you might sell is if After figuring out your thesis on this company, your story, you go through all the different checkpoints and you decide this is a wonderful company and that you want to own it. And then you're supposed to reevaluate your position, reevaluate your entire thesis at least once a year, if not more often. Maybe even a week after buying or a month, you realize you've made a mistake. You looked at the wrong number, you calculated the wrong thing. It's not a wonderful company. Maybe you find out something about the CEO. So he's the same CEO as when you bought, but you didn't know that this one thing about him, and now suddenly you do. So you realize you've made a mistake. Somewhere in your story and your thesis, you were wrong. Maybe it comes out that the numbers were even wrong that they reported to the SEC. So if you've made a mistake, that is a unplanned reason to sell, but you should get out. If it's not, if it doesn't meet your original criteria, you find out you've made a mistake, you need to get out. What do you make of that one?
I think that in this case, you really need to understand and you really need to think whether you will be in the loss or in short-term gain. But anyway, if something has changed, I also had this situation when I just rethink about the company and I look at this at completely different angle. And I just decided to sell. But when we, as value investors, 10 or 15 stock portfolio, and we have like 10% in this particular stock, we can be wrong on 2 or 3 of them and still be in a good position. So if the company, another company which we chose, did like 4x or 5x, we will be okay as a whole in the portfolio.
Absolutely right. So yeah, if you find that your original story was wrong, you need to evaluate if you want to stay in or get out. And I would say generally it's probably a wise idea to get out, because if you stay in and those criteria aren't met, you could be looking at very bad losses that you're basically going to destroy capital and it might never recover. The reason we only buy wonderful companies is because they don't destroy capital, they compound it. So that's reason number one. Another reason to sell under the unplanned reasons to sell would be very similar. Not that you made a mistake, maybe you were 100% correct, but over time, these figures can change, and over time, management can change. And if the story changes, it's just as bad or worse than if you'd made a mistake in your original calculations. Making a mistake would be reason number one, and the actual story changing would be reason number two to sell. Any thoughts on that?
Yeah, I think that if we speak about the second situation when something has changed, whether it's management or some unexpected situations, I think we as investors, as value investors, need to think about such outcomes. So, for example, like there was a situation with Pabrai investment in Ferrari when he invested a large sum of the money, but the manager unexpectedly passed away. And in this case, he needed to rethink about his position and exit eventually from the company. We need to analyze such outcomes, as I said previously, and we need to consider that if the business will still be good when the management will change, or if something unexpected occurs, like war conflicts, pandemic, or other stuff.
So the next one is if a better opportunity comes around, you might want to sell. So even if you're certain that your money will double in just a year in this particular company, even if you're 100% certain, which is never really possible, but let's just say you were, if something else comes along that's 100% certainty that it's going to go up by 5 times, you should sell that doubling position and get into that 5 times one. So always look at, is there a more certain double or growth that you were expecting from this company? If it's more certain with the other company, certainty would be a reason to move. And also, if it's a higher amount of growth at the same level of certainty, also might be worth moving. Obviously, consider your own situations and determinations, but I would say that a better opportunity is a reason to sell. What's your thoughts on that?
I definitely agree, as you said previously, which says that you can really evaluate the opportunity by comparing it to other opportunity, like different stock investing or different asset class, and etc. Speaking about the history, we can actually go to 1960s when Buffett ran his partnerships, and he actually sold some of his positions in the private companies in order to put 25 or 30% of his net worth, which was like several $1 million, into one particular company, and it was Coca-Cola.
And look at the returns he got on that.
Yeah, so
um,
actually he evaluated that this opportunity is the life-changing deal, and you need to sell other positions in order to catch this particular thing.
Absolutely. So that leads us to the next one, which is very similar in a way. Might not be the same with regards to growing your capital or safety or certainty, but it is similar to better opportunities in that no matter how wonderful your portfolio is, if something comes along that you need the money for in your life, an external thing, maybe it's medical bills, or maybe you're retiring and you really want to spend your time on the ocean. It's time to buy that yacht. It is okay to spend your money on things that you think are important. Obviously, weigh the pros and cons and benefits, but if you never spend your money, what's the point of even having it? And so some people will sell off stock when it's time to pay taxes, or unexpectedly large taxes, or buy that yacht or medical bills, or go on that vacation. Liquidating a little bit might be the right thing to do, and so that's a reason to sell, and should be mentioned. What do you think of that?
Yeah, and actually, you also need to be very careful when you try to copy the strategy of gurus and go to websites like Data Roma, Guru Focus, etc. Because there is a great quote which I really like from Manish Pabrai, that there is only one reason why people buy their stock in order to make the money, obviously. But there can be thousands of different reasons why these people sold this stock. And as you said previously, they may need the money for their children or their vacation or different purchases or just for tax loss harvesting. So this is the end of this episode. We hope that you really enjoyed it. And if you have any questions, please write them down in the comments below. Also, please subscribe to our channel for more videos, and see you next time.